Hello guys, welcome to Master Action. This is Sharath. In this video, we are going to discuss how to keep a proper stop loss in day trading or in short-term trading. Which is most important is stop loss. Keeping your capital safe and keeping your invested money safe without losing all the money that you have been invested in your trading account is very important when it comes to a stock market business. First of all, you should remember that stock market is a business. If it is a day trading or short-term trading or it may be a investing, everything is a business. In every business, if you lost all the money that you have been invested in that business, then that business is a loss and the interest you had upon that business will be lost. So keeping the money that you have been invested in the stock market or your trading account is very important when it comes to day trading business or short-term trading business. So how we can save our money that have been invested in our trading account? By putting stop loss. By putting a simple stop loss, we can save lots of money that we have invested in the stock market. So the thing is how to keep a proper stop loss, how we can save our whole capital rather than burning all the capital that you have been invested in the stock market. Most of the people, when they enter stock market or when they start day trading or short-term trading, the most common thing or most common problem of most of the beginners is they lose all the money they have invested or they have in the trading account. This is because most of the people come to stock market just because to make money or without any good knowledge. So whenever you enter a trade, you should always have a stop loss. So how to keep a proper stop loss? Even I lost so much money in the stock market when I was a beginner. So from my experience and from my trading style, I will explain how you can keep a proper stop loss and how you can save your capital for the further trading days. Stock market is like a marathon. It will be always there. So you should keep your capital safe and you should be there in the pitch. Stock market business is like a test match. In test match, what happens? Until and unless you are on the crease, you can score any sort of runs. You can score singles, you can score doubles, you can hit sixers or fours. So the main thing is you should be there on the crease. You should not lose your wicket and not go to the pavilion. So this is more important in stock market. You should always be concentrated about saving your capital rather than making profits. If you can save your capital, then you can think about the profits and then you can improve your trading skills with lots of experience. Everybody will face losses. I am not saying after watching this video you will end up with a big profit or you won't get any losses and all. You will face losses. I am just explaining how you can minimize your losses in your trading business. So let's get started with this video. Before that, I request you to subscribe my channel so that you will get notification if I upload a next video and if I upload a new video so that you will get notification for the next video. So please subscribe my channel and please make sure that at the end of the video, if you like this video, please click that like button. So let's get started with this video. Please subscribe. I will wait for 2 to 3 seconds so that you can subscribe and let's continue this video. So first thing is why stop loss is important. Why this stop loss thing is very important. Why everybody is talking about stop loss. Why we should stop our loss. Why we should take our losses in the market. So what is stop loss? Stop loss is if you enter a trade at around 100 rupees, for example. If you entered a trade at 100 rupees thinking that that trade will go around 110 rupees. Okay, it will reach around 110 rupees and you will book a profit at 110 rupees. Okay, this is the thing. Whenever you enter a trade, you will always think about the profits, right? If you entered at 100 rupees and your thinking is it will reach 110 rupees and you will exit the trade. Okay. And another scenario is what if you entered at 100 rupees but it went up and suddenly reversed and came down. Okay. You entered at 100 rupees and for example it reached till 103 and it suddenly reversed from there and made a big bearish movement to the downside. So if you didn't put stop loss here, what is stop loss? Stop loss is you're keeping a limit, you're keeping a stop where you can exit if the market reverses. So if you entered at 100, if you kept your stop loss at around 95 or something, if you kept your stop loss as 95 and if market reverses from anywhere, like after moving to 101, if it reverses and if it comes to 95, you will be exited from that trade. This is stop loss. What if you don't keep your stop loss at 95? If the market moves in an upward direction and suddenly reverses and it might reach till 70, who knows? Who can understand market? There is nobody, even professionals don't know what happens next in the market. Nobody knows what will happen in the market at the next moment or the next second. So stop loss is important for that. So if it moves to till 70, if you invested 100 rupees in that trade and if it moves to 70, you lost 30 rupees. That means 30% of the money is gone if it suddenly reverses. You can just predict a market. You can't say what exactly will happen next. So market is not exact science, it is a probability. It's all about probability. Everyone will bet on something regarding their analysis and regarding their fundamental or technical analysis, whatever might be the analysis. They're betting on the price, they're betting on the market, they're betting on the company. This is the thing. Okay, so if market reverses, you can exit from this point. This is why stop loss is important. In every trade, this is important. That is why stop loss is important. If in case market reverses, you will be exited from that trade at 95 rupees. 95 means what? Around 5% loss you have to take. That will be upon you, that will be upon to your risk reward ratio, or that will be according to your risk, that will be according to your trading style. But 5% loss is better than 30% loss or 50% loss. You get that, right? 5% loss is better than making a big move in the opposite direction and losing most of the money that you have in your account. If you lose 50% for every trade without keeping any stop loss, your account will be zero in just 2 trades. So stop loss is very important in any trade. Okay. The first important thing why stop loss is important is no strategy works 100% all the time. If you have a strategy and if it works for 60% of the time, then also you can make good money for that month. For example, if you have a strategy and if that strategy works only 60% of the time in a month, then also you can end up in a good profit for the month. The thing is, most of the professionals also have a 60% accuracy strategy. They don't have 100% accuracy strategy. They have only 60% or 50% accuracy strategy. In that they use stop loss and they use risk reward ratio so that they will end up with a big profit in the end of the month. 60% accuracy is ideal. Like if you have a 60% accuracy in your strategy, then you are a good trader and you have good accuracy in your strategy. No strategy works 100% all the time. Only 60% of the time it works. 40% of the time it might fail. There might be a strategy which has 70% accuracy. There might be a strategy which have 30% accuracy. Whatever strategy it may be, no strategy works 100% all the time. Anytime market can go and reverse. Market can go and reverse. So nobody can judge a market. Nobody can predict exactly this will happen next. Nobody can do that, and this is not okay, and every strategy fails at some time. So keeping stop loss is very important for our safety. Next thing is, trading is all about probability. Trading is not exact science. You are probably thinking market might move in this direction and hit my target. It might reverse from any time. It might reverse from any point and hit your stop loss, or it might go in a loss. So market is all about probability. Nobody knows what will happen. Even the biggest players in the market will face losses after having so much of experience, because market is a probability. Market will not listen to anybody. Nobody can control the market. Even big players also lost crores of money. Win big when you are right and lose small when you are wrong. This is important. Win big when you are right. For example, you did a technical analysis. For example, you have a wonderful breakout strategy and you know that price is consolidating in that point for so many times, and you know that once that price break this level, then you can have a big upside movement and you can have a good profit with that trade. You have this strategy. But the thing is, what if market breaks out this consolidation level and reverses and goes in a loss? So there is a chance that this might also can happen. So that is why if market reverses from this point, then you can keep a stop loss below this breakout range so that you can minimize your losses. You might get a big profit if market moves in your favor, and if it reverses, you go with a minimum loss. You go with a small loss. That is what win big when you are right. When your prediction goes right, you can win a big profit. When your prediction goes wrong, lose small amount of money. That is why stop loss is important. If you kept a stop loss, you are safe now. Your losses are fixed. You kept your stop loss and your loss is fixed to some amount or some percentage. So win big when you are right and lose small when you are wrong. So stop loss is very important. The last thing is learn to save capital before making profits. Whenever a beginner enters a market, he always thinks about profits. He will invest 1 lakh rupees and he is thinking that he will make 10,000 rupees regularly and he will make big money and he will buy a Lamborghini or something and he will do all the expensive shits and all. So this is the thing whenever a beginner comes into the market. But the most important thing is save your capital. If you ask any professional or if you ask me, even I lost so much money in the market after experiencing loss, after losing so much of money. Then we stick to the market and then we learned what is market, how to trade in a market, how to make money in the market, and now we are getting good grip in this market. So the first thing is learn to save your capital. The first most important thing is learn to save your capital. How to keep proper stop loss in 5 steps. How I can keep my stop loss in 5 steps. The first thing is trading is a business. You should treat trading as a business. It might be investing, short-term trading or whatever. Trading is a business. You invested your money. Your money is working there. So trading is a business. You should treat it as a business and you should always remember that every business has its own process. Every business works on a process. If you think about any business and that business has some process, okay. If you think about a tea shop or something, he buys a tea powder or milk or sugar or everything, calculating his investment and calculating his returns. And he also calculates how many customers will visit his shop for a day, and if those customers will not visit, what will happen. He also has an idea of his loss. Every business has its own process. So process is important in any business. So treat stock market is also a business. So how we can keep our proper stop loss in 5 steps. So proper stop loss means how you can save your capital, like whole capital. I am talking about whole capital in this video, in this process. So let's see how we can save our capital by keeping a proper stop loss. The first and most important rule of stop loss is the 2% rule. 2% rule means you should only lose 2% of your capital for a day. You should not lose more than 2% for a day. For example, if you invested 1 lakh rupees and you are a day trader, maybe you are an experienced day trader or you know some of the strategies and patterns. If you have 1 lakh rupees, then your concept should be you should lose only 2% for a day. If market reverses from your prediction, market goes in your opposite direction, then you should lose only 2% for that day. That means out of 1 lakh rupees, you are ready to lose 2000 rupees, and if market goes in your favor, then you should make 4000 rupees. That is called as risk reward ratio. You should always have 1:2 risk reward ratio, and most people think that I will take 5% risk and I will make 10% profit. There is a problem with this risk reward ratio, because if you risk 5% and your strategy works only 50% of the time, if 10 trades continuously goes in your opposite direction and you have 5% risk on every trade, and your 10 trades continuously goes wrong and hits your stop loss, then you will end up losing 50% of the money just in 10 trades. That might be in 10 days or that might be in a 5 days, whatever. So risking your money is very important. You should always risk only 2%. Even if 10 trades or 20 trades goes in opposite direction, by risking only 2% of your money, only 2% of your capital, then also only 40% of the money will be gone. In this scenario, you lost 50% in 10 trades. You lost only 40% in 20 trades. This is important. How many trades you took and how many losses you made. So 2% loss for a day is ideal. Even if you watch any YouTube video or any big YouTuber videos who do trading videos, or if you read any books, or if you listen to the speeches of some biggest successful professional traders, they will suggest you to take only 2% risk for a day. That means in day trading, 2% risk is ideal for a day. Like 1 is to 2 risk reward is there, no? In that you should risk 2% and you should make 4% for a day. So this is the first rule. You should only risk 2% upon your capital. If you have 1 lakh, then you should risk 2%. That means 2000 rupees is your risk for that day. You will save your capital. For example, if 22 trading days are there and your account had 1 lakh rupees at the start of the month, out of 22 trading days, you lost 20 trades, for example. For 20 days, your stop loss has been hit. Only 2 days you went with a profit and you have a risk reward ratio of 1:2 and your risk for the day is only 2%. For a day, if you lost 2% and if you fixed the 2% loss rule, then at the end of the month, if you lost 20 days, like for all the 20 days, if your stop loss hits, then also you will end up with 40% loss. That means your 1 lakh capital will become 60,000 rupees. With this 60,000 rupees, you can trade another month. Okay, you lost 20 days. Out of 22 days, you lost almost 98% of the days. That means 40% loss if you take 2% risk for the day. But think about this scenario. You are risking 5% money for a day. You are like, I will risk 5% money and risk hai to ishq hai. I will make 10% returns on my risk and everything. But if you lost 20 trades for a month, out of 22 trading days, you lost 20 trades. Like 20 days, you are on loss. Your stop loss is getting hit for continuous 20 days. You have 1 lakh rupees in your account. Okay, your risk is 5% for a day. After 20 days, just think about this. Your loss will be 100%. You lost 5%, 5%, today 5%, tomorrow 5%. Out of 1 lakh, 10% is gone. After 20 days, you lost all the money. Your account is zero now if this scenario happens, because trading is like a probability. You can't say exactly what will happen. I'm just giving a scenario. Just imagine this. If 20 days goes with a loss, you will be zero. Your 1 lakh will be zero. Okay, but what with the 2%, you will end up with 60,000 rupees. That means you saved your capital. Little bit capital has been saved even with 20 days loss. Okay, this is very important. 2% rule. Before doing a day trading, always think about the 2% rule. If you have 10,000 rupees, just risk 200 rupees for a day. If you have 10 lakh rupees, just risk 20,000 rupees for a day, so that you can reward with 40,000 rupees. 40,000 rupees is not a small money with 10 lakh rupees investment if your risk reward ratio is good. So the thing is, 2% rule is the first thing. You should calculate your daily risk in day trading before the market opens. The second thing is number of trades per day. In a day trading, most of the people take 10 to 15 trades for a day. Most of the beginners will do. If I take 10 trades or 15 trades, I can make good money for that day. Most of the beginners will do this thinking. But the thing is, most of the professionals or most of the people who are successful in the day trading journey take only 2 to 3 trades for a day. So what happens? They will take only 2 to 3 high probability trades. If that goes in their direction, then they will make a good money. If that goes in their opposite direction, they will lose with a small amount of money. So number of trades per day is very important. It all depends upon you. It will be completely dependent upon you. There is no rules for number of trades. You can take 10 trades. It's up to you. It's completely up to you. But the number of trades, you should decide how much trades you will take for a day. There are people who take only 1 trade for a day. There are people who take 2 to 3 trades for a day. That is me. Actually, I will take only 2 trades for a day. If 2 trades goes in my direction, then I won't take another trade and I will close my laptop and for my day trading is done for that day. If 2 trades goes in a loss, then also I will exit from the market for that day. But if 1 trade goes with a win and 1 trade goes with a loss, then I will take another one. If that goes in a loss or profit, I will exit from the market for that day. So there are people who do like that. There are people who take 4 trades. There are people who trade 5 trades for a day. So it is completely dependent on you. How many trades you will take for a day is completely dependent on you. You can take any number of trades for a day. There is no rules like that. But over trading is not so advisable in day trading. You should not do over trading because you can't control your emotions, because loss is there in the market. Nobody can say this strategy or this thing will make you profitable. So you should think about the number of trades for a day. in my first step I decided my loss. Okay, I will lose 2%. That means for 1 lakh rupees I will lose only 2000 rupees, and I will take only 2 trades. That means only 2 trades I will take, one in Reliance or one in HDFC, whatever it might be, even if it is in Nifty or Bank Nifty, whatever, where my strategies or where my pattern will appear, I will enter that trade. That is only 2 trades for that day. It might be in any trades, HDFC, or in HDFC only I can take 2 trades for that day. That might be anything. I will take 2 trades. For example, just imagine I will take 1 trade in Reliance and 1 trade in HDFC. What happens? My risk is 2000 for the day. I fixed my risk. 2% risk is fixed. So if I taking 2 trades, then my risk per trade is 1000 rupees. If I enter Reliance for a trade, then my risk is only 1000 rupees for that trade. And if I enter HDFC, then 1000 rupees for HDFC. First I will think about the risk, then I will think about the profits. First thing is, you should always think about how much risk you are taking. Upon that you should calculate your profit. If you are taking 1000 rupees risk, then you should always target about 2000 rupees profit. This is called risk reward ratio. For 1000 rupees you are taking 2000 rupees profit. If you are a trader who takes only 1 trade, then you can risk 2000 rupees for that one single trade, and if that trade goes in your favor, then you can book a profit of 4000 rupees. That is 1:2 risk reward ratio. And if that trade goes in the opposite direction, and you can take your loss of 2000 rupees. Okay, this is how you should maintain the number of trades upon 2% rule. That is the fixed amount of loss you are facing or you are ready to take. This is how you should decide the number of trades you are going to take, and this is how you should decide your risk per trade upon every entry. So for 2 trades you are risking 1000 rupees, and if you are a trader who takes 4 trades for a day, and you should divide that 2000 rupees, that means divide that 2% by 4 trades, then 500 rupees for every trade, 4 trades. Okay, hope you are getting the point now. If you have any doubt, you can comment in the comment box and I will answer that doubts. And also, this is how you can decide your risk for every trade. Like, you are not risking so much of money. Like, your risk is fixed for a day, 2000 rupees. Now you are deciding the number of trades, how much trades you should take. It might be in index, it might be in stocks, whatever. You should define your risk for every trade. Before making any profits, you should define your risk, how much risk you are going to take. That should be first decided, then you decide about the profit. It might be 1:2, 1:3, 1:4, whatever the profit you are expecting, that is up to you. That is completely up to you. So your analysis and your thinking, you can take 1:4 profits also sometimes. So risk should be fixed. You should think about the risk at the first and most important thing. Okay, so first thing is 2% rule, second thing is number of trades. The third and most important thing is strategy. Which strategy you are using? For example, breakout strategy. For example, if I tell you one thing, in my previous video, I think I explained about how to identify proper breakouts in 5 steps. I think that is the title of that video, and in that video I explained about a strategy. It is a typical breakout day strategy. In that, what will happen till 12:30 or something, market will be in a consolidation mode, and after 12:30 or 12 o'clock, market will break that level and make a big move. This is the strategy that I explained in that video. So there are 5 steps for that strategy. The first thing is, you are entering the market after 12. Okay, after 12 o'clock only you are entering the market. And the second thing is, it should be a typical day. What is typical day? You can watch another video regarding types of days, that is 6 types of trading days every trader must know. That is the title of that video, and you can watch that video. So it should be a typical day, and you are entering the market at 12 o'clock. And the third thing is, it should break from that initial high or initial low, then you should enter that trade. That is the strategy, that is the concept of that strategy I explained in that video. You can watch that video later for the complete understanding of that strategy. You can watch that video. It is a good strategy and you can use it with a proper back test. So third thing is, strategy is very important. The third and most important thing is, strategy is very important. Most of the people, what they do is, like, If they see a big Mariposa candle, if they see a big green candle, they will enter that trade without doing any back test or something. They will enter that trade keeping their stop loss here or somewhere here, keeping stop loss below that wick or somewhere below that level or somewhere. But you didn't backtested that strategy. You don't know what will happen next. You just entered because of a big bullish candle. Bullish candle means market will go up. Green candle is a signal that, oh, now you can enter the market and you go up. So that is not the case. You should have a backtested strategy. You should always have some backtested strategy so that you know what will happen. You know where to keep a stop loss. You can understand where I can keep my stop loss with this strategy. Let me show this breakout strategy in live charts. So that you will get some idea regarding how to keep a stop loss and something. So the thing is, you should always have a strategy before entering into any trade. You should not enter a trade if you don't have the strategy. Randomly, you should not enter a trade. So that is the thing regarding the third step or the third point, that is strategy. Let's see that in our chart. Guys, this is a chart of HDFC and this is a chart of 17th February 2021. Here you can see typical breakout strategy. Here is the breakout strategy that I had explained in my previous video. According to that, the first condition is you should enter the market after 12 o'clock. Where is the 12 o'clock candle? Here is the 12 o'clock candle. Okay, 12 o'clock candle is there. It is a typical day. You can see here price is making a downside move and price made an upside move but didn't touch the initial high, and price again made a downside move and price was in a consolidation for a long time. Price was in this range for so much of the time. Now what you should do? You should think about the breakout after 12 o'clock. You should wait till 12 o'clock. So I will mark this position. I will just mark this position according to that strategy. You can watch that video later. I will just mark this zone and I will wait for 12 o'clock. I am just waiting for the breakout. Either it might be in a downside direction or either it might be in the upside direction. Whatever might be the direction, after 12 o'clock, if market breaks any of the levels like initial high or initial low, I will enter this trade. Okay. So I just marked that level and I am just waiting after 12 o'clock. This is our 12 o'clock candle and I'm just waiting for the breakout. So, and you can see here at around 12:45 market broke this initial low. You can see here market broke this initial low at around 12:45 candle. Okay, market just broke that initial low. So now that is your entry. You should patiently wait till that breakout. After 12 o'clock candle, it broke at around 12:45 till 45 minutes. You should wait. You should not enter anywhere thinking that it will break out or something. You should always wait for the breakout. You should always see the candle how it is breaking the initial low. Now initial low has been broken. So now the thing is, do you know this strategy will work? This strategy is a good backtested strategy, and even you also backtested this strategy, for example. Okay, now you should know that you entered here somewhere around 1605. You entered here and you should keep your stop loss above this candle by keeping some buffers. Like this is high of 1609 and you will keep a buffer of 1 to 2 points or 1 to 3 points depending upon the stock or index. If it is a 500 rupees stock, you can keep a buffer of 1 point or 2 point. If it is a 2000 rupees stock, then you should keep a buffer of 2 to 3 points. Depending upon the stock, you should keep a buffer above that level. Here the level is high of this breakout candle and you should keep a buffer. I will keep around 2 to 3 points for HDFC and all. 1609 is the high of this breakout candle. I should keep my stop loss above the high of this candle. You should always have some buffer above the level of the breakout line. So you entered at 1605 and your capital is 1 lakh rupees and your risk is 2000 rupees for a day and your trade is only one for that day. You are a trader who takes only one trade for a day, just for an example, and your risk per trade is 2000 rupees. You fixed your risk. Now 1605 is your entry. This candle is the breakout candle. 1611 is your stop loss. If market comes to 1611, you will exit that trade. So 1605 is your entry and 1611 is your stop loss. Okay, sometimes stop loss will be very light or narrow, or sometimes stop loss will be like very not so big and all. So sometimes stop loss will be medium size stop loss. So it will depend upon the levels of the breakout candle, whatever, how you're entering that trade. So it is always about your strategy. If you are entering with any indicator strategy, then you know where to keep a stop loss, and you should always keep some buffer below that level, around 2 points or 1 point, depending upon the stock. So for this strategy, the stop loss is above candle. For CPR or virgin CPR strategy, that is the video is there in my channel. You can watch that video also. Virgin CPR strategy, you should keep a stop loss above the CPR, like above CPR you should keep a stop loss, and that will depend upon the strategy. Okay, now the stop loss is 1601 for this strategy, above the high of the breakout candle, and you should keep some buffer. Okay, so now what happens, loss is 6 rupees for this trade. 6 point is a loss, 6 rupees is a loss for this trade, single trade. If you wanted to buy one HDFC stock, your loss is 6 rupees. For 2000 rupees, how many stocks you can take with the 6 rupees loss? 2000 by 6. You are a trader, only takes one trade, and your loss for this trade and this strategy is only 6 rupees. Your loss per day is 2000 rupees. Now you are getting the point, right? 2000 rupees your daily loss, and your risk per trade is 6. Now you should divide 2000 by 6. So your risk per trade is 2000. Your daily loss is 2000. It is fixed. But your strategy says you have a risk for that trade is 6 rupees. For one trade you have 6 rupees loss. Now your stop loss is fixed to 6 rupees for that trade. Now you should calculate. You will get the 3333 quantities for that trade and for that stop loss. For 2000 rupees fixed stop loss, your quantity is 3333 quantities. You should only buy 333 quantities in HDFC. I marked a horizontal line here below this initial low, and I just marked with a eclipse, and you can see here this is a breakout candle. Our stop loss is around 1611. I just draw a horizontal line. This is our stop loss, and this is our entry 1605. Somewhere here 1605, consider it as a closing of the candle. So your quantity is 3333. You are going to buy only 333 quantities. Regarding your risk, you are buying 333 quantities, and even if your strategy fails, if that strategy fails, there is a chance that strategy might fail. Even if that strategy fails, your risk for one trade is 6 rupees. Your stop loss is 6 rupees. Your number of quantity is 333. Now your loss is fixed to 1998. That is around 2000 rupees. Okay, you understood, right? The first thing is 2% rule. For 1 lakh rupees, your loss is 2000 per day. Number of trades, you are taking only one trade. So 2000 rupees for single trade. The strategy is breakout strategy. Your loss for that trade is 6 rupees. You should divide loss per trade. 6 rupees means your quantity will come. 333 is your quantity. You should not buy more than 333 rupees just to maintain your fixed stop loss for that day. If 333 quantity trade you took on that trade and your strategy fails, what happens? Rather than going in your favorable direction, if it reverses and hit your stop loss, if it reverses till 1611 and moves in upward direction, you face a loss. So if it goes in a reverse direction, then 333 into 6, that is your loss per trade, and that will come to 1998. That is around your fixed stop loss, that is 2000 rupees. Okay, this is why strategy is important. You should know the strategy. You should have a back-tested strategy, and upon that you should calculate the quantity and you should enter the trade. You should not buy more quantities thinking that this strategy will work all the time. This is how you should calculate your quantity also. So stop loss is very important for calculating your quantity. Let us see another example where this strategy might have failed. I will check another strategy where this strategy failed. So let's see that. So on 13th of April 2021, you can see here the same strategy appeared again. You can see here typical day. It was a typical day and market was in a consolidation till 12 o'clock, and your entry is after 12 o'clock. So this is our range. I will mark this range. So you can see here, this is our range. This is the chart of 21st April. You can see in HDFC chart. This is the low of that day, and this is the high of that day, and market was in a consolidation till 12 o'clock. This is our 12 o'clock candle around this is our 12 o'clock candle, and we should look for a breakout after 12 o'clock. So this candle broke the initial high, you can see here. So if you see here, this candle, this green candle broke the initial high. This is the initial high. This is the initial high, and this green candle broke this initial high. Now all the steps of this strategy has been completed. Now you think this breakout will work. But what happened after this breakout candle? You can see market went up and suddenly it reversed. Okay. Now just think, this is the breakout candle and you entered at 1382. Let us consider it as 1383. 1383 is your entry. And you think that market will move after this breakout because this strategy has the backtested strategy and this will work. So you thought that 1383 is your entry and you kept your stop loss lower wick of this candle. That means around 1380 with a buffer of some 2 points. 1380 with some buffers. You kept a stop loss at 1380. So 1380 is your stop loss. You kept your stop loss there. Okay. Now you should calculate your risk. You should calculate your quantity first. Your risk for that day is 2000 rupees. Okay. Your risk for that day, for one day, your risk is 2000 rupees. Sorry, 1380 is the low of that candle. I will keep a buffer of 2 points, that is 1378. 1378 is my stop loss. So 1378 is my stop loss. That means 5 points. 5 points is the stop loss for this trade. Now I should calculate my quantity. So 2000 rupees is my risk per trade, and 5 points is a loss for that single trade. How much quantities I should take? 400 quantities I should buy regarding this strategy. I bought 400 quantities at this level, that is 1383. At this entry level, I bought 1383. I bought 400 quantities. Okay. I thought market will move in my direction, but it reversed after some times. You bought 400 quantities and you have 5 rupees risk for trade. That will become 2000 rupees your risk. Your 2000 rupees risk has been gone. Now you end up with a 2000 rupees risk, that is 2000 rupees loss you are taking, and you are ready for that risk because you calculated your risk, you calculated your number of quantities, you calculated your risk per trade. Everything is fine. You don't have any problem. Now you don't have any emotions. You are ready to lose that 2000 rupees because you already fixed your losses. You already counted your trades. Now you won't take any trades further. You will close your laptop and your trading for that day is gone. You end your trade for that day, and you already fixed that you are taking only one trade with 2000 loss for that day. Now you lost your money and your stop loss has been hit, and now you close the laptop and you are trading for that day's end. You can trade next day. So this is how you should control your emotion. The video is going very lengthy, so I hope you understood this concept. If you have any doubt, you can comment and you can ask in the comment section. I will explain that concept. So the third thing is strategy. The first rule is 2% rule, second rule is number of trades, third rule is strategy, and the fourth rule is don't move and average your position. As I explained, you should keep a buffer below your entry candle for that strategy only. Different strategies have different entries and different exits and different stop loss. Every strategy has its own entry exit points. For that strategy, you should keep a buffer below the lower wick or the low of that candle. Some people, what they will do after an entry, if this candle starts reversing and comes near the low of this candle, they start moving their stop loss. They will keep moving. In this case, you can see here market went up and suddenly reversed. What some people will do, they move their stop loss from here. They keep below this and they move stop loss 2 points again, 2 points again. They think that market will reverse sometimes. Market might go up from here. Market will move from here. So they think like that. But the thing is, trading is a probability. Trading is not an exact science. You should fix your stop loss and you should not move that stop loss at any cost. If market reverses, then also you should not be fearful. You should control your emotions because you know what is your loss and you fixed your losses. That is the loss you are taking. You know your reward. So you should not be fearful. You should leave that fear of stop loss. You should take that loss and think that market gave a loss for me today. So you should take that loss. You should not be fearful and you should leave that emotion. So you should not move stop loss once you fix that stop loss. So you should not average or move that stop loss. Some people, what they will do, they trust that strategy so much that they will start averaging. Once market comes down, they start averaging. They will buy here, they will buy here, they will buy here, thinking that market will move up. What if market falls down completely? All the profits that you earn from so many days will become zero. So don't average and don't move your stop loss. That is the fourth thing you should consider in keeping a stop loss. The last point is exit with big profit or small loss. Don't fight with the market. That is what I said, 1:2 risk reward ratio. If you are taking 2000 rupees risk, you should exit with 4000 rupees. You should not risk 2000 rupees and your profit should be 2000. You should always think about 2000 to 4000. If you are risking 2000 rupees, then your target should always be more than 4000 rupees. You should always think about 1:2 risk reward ratio. You should not book your profit risking 2000 rupees and getting profit of 1:1. That is not okay. That is not the style of trading. You should always risk 2000 and always take 4000 rupees profit. If you are risking 200 rupees, then your take profit should be 400 rupees. That is the point. So you should not take a risk of 200 rupees and book a profit of 100. That is 1:0.05. That is of no risk reward ratio. That is of zero risk reward ratio. That is of no use. If you are risking 200 rupees, then you should book more than 400 rupees profits. That is called as risk reward ratio. You should always think about the profit in 1:2 risk reward ratio. If your stop loss hits also, then you are going to lose only 2000 rupees. That means 2% of your capital. So this is how, when you win, make sure that you win big. When you lose, make sure that when you lose small. That means you enter a trade thinking of a big win and small loss. Only two things you have to think when you enter a trade. Once you enter a trade, then you should think about the risk reward ratio and you should be ready to take that loss. Okay. If you can't see such trades, then don't enter. If you can't see such trades, that means you entering a trade and your target is small and your stop loss is big, then don't enter. Even if that trade works well, then also you don't enter that trade, because risk reward is very important in trading. I will explain that later, because video is getting bigger and bigger. I don't know, will you watch this video till the end? If you're watching till now, then please make sure that you like this video and comment your opinion, and please subscribe this video and share this video with your trading mates, so I can make good videos again, so I can explain deeply some of the important things of day trading. Thank you for watching this video, and subscribe for more videos, so that if I upload new videos, you will get a notification. Please make sure that like this video, and if you have any doubts, if you have any suggestions, if you have any ideas, or if you want any topic, any videos relating to any day trading topic, you can comment and tell me, and I will check for that, and I'll make a video on it. Thank you so much for watching this video, and I hope this was helpful. Let's meet in the next video with wonderful content about day trading. Thank you so much. Have a good day, traders.